Thank you. Zach Goldfarb from the Washington Post. Two questions. First, can you clarify whether if actual economic conditions match the projections, that's an acceptable future course or that would require additional easing? And secondly, in the past, a number of times you said that even when interest rates are at the zero bound, the Fed can still have a significant impact on influencing economic growth. Do you still believe that the Fed has the capacity to deploy tools that would have a significant impact on bringing down unemployment at a faster pace than we see in these projections if it chose to do so?
On the first question, this, as was pointed out by Steve, for example, we've had some good data recently. I think there's some uncertainty about where the economy is going, and we want to continue to observe how the economy is developing. But I would say that, as I've said in several answers, that if recovery continues to be modest and progress on unemployment very slow, and if inflation appears to be likely to be below target for a number of years out, so the configuration we're talking about in the projections, then I think there would be a very strong case based on our framework for finding additional tools for expansionary policies or to support the economy. So we'll continue to look at the different options and try to decide what might be most effective. We are in a difficult situation in terms of effectiveness of policy tools. My own view, thinking about the effects, for example, of additional securities purchases, I've been pretty satisfied in the following sense that purchases do seem to have the desired effects on financial conditions. They tend to ease financial conditions. They tend to lower interest rates. They tend to strengthen asset prices, and those are exactly the kinds of things that monetary policy normally does in order to try to provide stimulus to the economy. What has been a bit more uncertain is the effectiveness of the transmission mechanism, and we have seen some developments in the economy that have probably weakened the effectiveness of policy, including notably the housing sector, where one would expect, with mortgage rates below 4%, one would expect to see more activity than we've been seeing. And the problems in housing finance and so on are part of the reason that these expansionary stimulus is not feeding through as much as we would like to the real economy. I would not say, though, that our policies that we're out of ammunition. And no, I think we still have tools, but we need to further analyze and study those tools and try to make comparisons in terms of effectiveness, risks, and the like. So I think we still have a process to figure out what is the most effective approach. Is that? Yeah. Okay.
We're going to go to Steve Beckner and then Hughes.
Steve Beckner of Market News International, Mr. Chairman. With a question about the new forward guidance language and the statement itself. And Peter anticipated one of my questions about the potential danger of it sending a negative signal. But let me ask, what was the rationale for continuing to have forward guidance phraseology instead of just letting these new forecasts of the funds rate speak for themselves?
No, that's a very good question. I might have commented on Zach's question that our two main tools at this point, given that short-term interest rates are close to zero, are asset purchases, but the other is communications. And to the extent that we can communicate that rates will be lower for longer, that will ease financial conditions and be a way that we can affect the state of the economy. And that's part of the reason, other than just general desire for transparency, that we brought out some of these ideas at this point. The reason that we just don't release the economic projections and leave it at that is because while the economic projections of future policy rates are an important input to our policy discussions around the table, the decision ultimately is made by the Federal Open Market Committee, which is the voters sitting around the table, and in a process by which we exchange ideas and make arguments and come to a collective determination. So, we don't set the federal funds interest rate by having members send in their vote and not having a meeting. We have a meeting for a reason, which is to talk to each other and try to come to some kind of consensus. So the FOMC will always, in some sense, trump the projections of forward interest rates, but clearly, because the participants and people around the table are the same, the projection should give significant information about where the FOMC is likely to go.
And we'll come over here to Hughes, and then we'll go to Scott.
Hughes Honoré with Agence France Presse. The FOMC stated that global growth has slowed, and of course that is weighing on financial conditions in the US. Arguably, one way that the Federal Reserve could help would be by extending a loan to the International Monetary Fund. There have been other central banks that have been doing that when the government was reluctant to do so. And we have all noted that the Fed was not shy when it came to extending loans to international financial institutions, private banks, and so on that are based or that have subsidiaries in the US. Is it something that you could consider if the sovereign debt crisis got worse?
Well, lending to financial institutions is part of our mandated function. It's part of our raison d'etre to provide a lender of last resort in the case of a panic, as we've done in the recent crisis. Committing funds to the IMF, I don't think, is within the purview of the Federal Reserve. That's a decision that's made in the first instance by the Treasury Administration, and in the second instance via approval through the Congress. So I think the appropriate deciders in that case would be the administration and the Congress, not the Federal Reserve.
Scott.
Scott Spory, sir, from CNN. My head's full of questions, but I'm going to try and limit it to two related questions. You're linking your inflation target of 2% to the PCE. The PCE is something that hundreds of millions of Americans have no idea what it is. They do know what the CPI is. Can you explain in layman's terms something that regular folks might understand, why they should not worry too much when inflation if the CPI is different than the PCE? And the second question is related to, also to inflation and to the targeting. Because the Fed's always been a little bit vague in terms of what sort of inflation it would accept, and this is a market change. Because criticism of the Federal Reserve, criticism of you, but the institution itself has been so intense this year because it's a political year. There are people out there who are going to say, the Federal Reserve has finally just admitted it. Their policy is to destroy 2% of the value of my dollars every year. How are you going to respond to those people? And also, could you answer the question about the CPI and the PCE? Thank you.
Sure. Well, we chose the PCE index for some, I think, very valid technical reasons. It better accounts for changes in people's purchasing patterns. You know, when some things become more expensive, people will tend to move to other types of goods and services. That's not accounted for by the CPI, which has a fixed weights. It also, the PCE, and I think more relevant to the average person, the PCE includes all healthcare costs, not just out-of-pocket costs. And that has two benefits. One is it reduces the share of the inflation index, which is tied to housing. And the CPI has a very large share devoted to housing, and a large share of that part of the index is imputed, that is essentially made up numbers. So that's one benefit, to keep the, not to put too much weight on the imputed housing numbers, which is part of the CPI. The other is that even if people are not paying for health care immediately out of pocket, they do pay for it, either through taxes or through reduced wages, as increased health care costs raise insurance premium for employers. So I think this is probably a better measure of the inflation that's faced by typical consumers than the CPI is. That being said, these various measures, the CPI and others, the PCE index and others, move very closely together. And you're not going to have a situation where the CPI is 10% and the PCE is 2%. I mean, there may be a few tenths difference, but generally speaking, they move very closely together. So in that respect, I think if people look at the CPI, they should feel pretty comfortable that, that's going to be pretty close to where the PCE inflation is. On the 2%, again, that's where the United States has been for many years. That's where most central banks are around the world. There's a very good reason for it, which is to avoid deflation, which is very negative. I think the argument that, the value of your dollar declines to 2% a year is just not really a very good one, unless you're one of those people who does their lifetime saving in the mattress. Most people invest in various kinds of instruments, receive a rate of interest. Now it's true, as been pointed out, that for the moment that interest rates are pretty low, but they're still positive. But over a longer period of time, even if you have money in a CD or some other investment vehicle, the interest rate will compensate you for inflation. I mean, the two will be tied together. So there really shouldn't be, at levels of inflation this low, interest rates should pretty much fully compensate for the losses to savers. But I would reiterate that we are not unaware of the problems that low interest rates cause for savers, cause for pension fund contributions, insurance companies, and other parts of the economy. And we do try to take that into account as we think about other ramifications of our policy.
Okay, this will be the last question. Peter?
Thank you, Mr. Chairman. Peter Koch with Bloomberg Television. Two questions, if I could, separate from your role here as Fed Chairman. Two issues in Congress right now, which your advice might be worthwhile. The payroll tax cut is coming up for debate again, this debate about whether to extend it for a full year. What is your assessment right now of the impact that would have on the U.S. economy if it was not extended? And likewise, what if the Congress were to not implement the 1.2 and automatic spending cuts imposed by the failure of the supercommittee? What impact would that have on the U.S. economy?
Well, as you know, the Federal Reserve makes it a policy to try to avoid commenting on specific individual tax and spending programs, and I don't have those numbers at hand in any case. But what I would say is the following, is that what I've tried to convey to Congress, and I think many other economists have taken the same view, is that responsible fiscal policy has at least two components at this point. One is, of course, importantly, to achieve fiscal sustainability. And to achieve fiscal sustainability over a long period of time, we need to be acting soon, now would be preferable, to making credible commitments to reducing spending, to improving our programs, to modifying or simplifying our tax code and so on, so as ways that will be persuasive to the markets and to the public that over the longer term, over the next 10, 20, 30 years, that our fiscal position will be sustainable. So that's an important thing to do. It relates to the second part of your question. I think it's important to take steps at least to, again, the specific steps are up to Congress, but it's important that action be taken to provide a credible plan to achieve fiscal sustainability. The second part of my recommendation, though, is that we need at this juncture to be sensitive to the effects of whatever policy decisions are made on what is still a very fragile recovery. Again, there are many ways to do that, but I think that should be taken into account as people are looking at policy alternatives in terms of taxes or spending.
Thank you.
Thank you.